All right, what's going on, team? Hope everyone's having a happy Wednesday here. So we're in the final stretch now. If you've been watching all of our videos, I think we've had 11 up until now, or maybe it was 10, something like that. The last three here we're going to be talking about in this one, managing your trade, which is very important. Take profit strategies as well as multiple different types of stop loss or invalidation strategies. And, it's up to you, whichever one you choose, or if you want to use a mix of them. And, feel free to mess around with it. Trading is a very personal thing, so don't feel like you have to use this. Maybe some variation of this, or maybe something completely different. This is just to give kind of a baseline for people that don't have any sort of take profit strategy or any sort of invalidation theory or anything like that, right? There's plenty of successful traders out there that have, dozens or maybe even hundreds of different profit taking and stop loss strategies. So don't feel like you have to use this one. Like I said, I just want to kind of give the one I like to use on average, at least. And I don't always use this sometimes. It all comes down to risk reward, right? If you want to wait longer and higher to start taking profits, the risk goes up, right? If something's up 2x, and you take profits, you're kind of guaranteeing that you won't take a full loss if it runs back to your entry. If you want to wait until it's 3x or 5x or 10x, that's fine, power to you, but all the way up, you're still risking the whole bag, which, again, there's nothing wrong with that. If you want to take a more risky play, power to you. I've done it. I've had success doing it. I've had big losses doing it. That's all part of the game. If you want to be super strict, then stick to this every time. And you're going to take a lot less losses than most people, or at least a lot less full losses, right? And we'll get into understanding what a full loss means in our final video, which will be about position sizing and risk management. That'll be 2 videos after this, and that is going to be the most important video of the course. Because it doesn't really matter what you know about trading. If you don't understand position sizing and risk management, you're probably not going to be successful in trading the markets. For this one, we're just going to focus on stop losses and profit taking strategies. Okay. And if you guys ever have any questions on this or you want me to expand on this a little bit more, you're always welcome to reach out to me in Block Circle. I'd be happy to shoot the shit with you all you like. So just give me 1 second here. Yeah, I'm still a little bit under the weather, so if you guys hear me mute my mic and pause for a few seconds, I'm probably just blowing my nose or something. But anyways, so managing a trade is actually where the majority of traders make big mistakes, right? They have no plan going into it. They're kind of just winging it, which, sometimes it's going to work, but unfortunately, when it does work, you're setting really bad habits. So always try to have some sort of plan before you even buy something, how you're going to trade it, what's your invalidation, how you're going to raise your invalidation as it goes higher and higher, where you're planning to take profits, where you're planning to cut it if things start to change, what's the thesis for this trade, what would change that thesis, so on and so forth. And, always be willing to adapt to what the market is telling you. And, you're not always going to be right. Try and accept as early as possible. You're not always going to be right. Good setups will fail. Sometimes your trade will be invalidated. You'll cut it and it'll be revalidated 10 minutes later, right? Which is okay, right? If you think the trade is revalidated, take the new trade. It doesn't have to be, oh, my first trade in invalidation was wrong. Oh, I knew I shouldn't have cut it. Yes, you should have, right? And then if you get a new setup right after and you want to risk it, take the new setup, but treat it as a new trade. Okay, so I'm going to go over the multiple different stop loss methods that I like. One of them I think is much better than all the others, but they're all pretty viable. It's just up to what you like. Sometimes I use a mix of them, right? I use pretty much, there's 4 I'm going to go over. I regularly use 3 of those 4. Like I said, one I think is a bit better for following the trend, but they're all pretty good. And then after stop loss methods, we'll go over my kind of go-to take profit strategy. And then after we look at that, we'll go through a couple of examples. We're going to be looking at Pepe today, as this is a pretty popular meme coin lately. It's got some pretty good structure, some clean setups, and it has some really good trends. So it'll make for a good example on stop losses and managing your trade and all that stuff. Okay. So, like I said, we've got, let's turn off volume. We don't really need that for this. We've really got 4 types of stop losses that I focus on, right? The first one is an EMA-based stop loss. The second one is a candlestick stop loss. The third one is a percent fixed stop loss, and this one is my least favorite. I actually never use this one, but I have seen some people have success with this. If you have nothing else to use, at least use this, but the other 3 I'm mentioning are so much better. Let's actually leave that one for last. Well, I was playing too. I don't know how to do it. But... And then the last, and in my opinion, the best, is a market structure based trailing stop loss. This is my go-to. This is the one I use for pretty much everything. And sometimes my entire trade will just be a market structure based trailing stop loss. If I'm low risk and I'm willing to just ride the whole trend, even if it comes back to my entry, this is the one I go to. I use it a lot. I would say this and really these 2. I mean, it's hard to pick one between. This one is going to have you out sometimes right before a new trade would start, but this is going to get you out a lot higher than this will. And keep in mind, for a stop loss, none of these are going to have you selling the highs. That's not really the point, right? The point is to be able to ride the trade from your entry through all kinds of different bumps in the road without emotionally deciding, ooh, that's, too much money, right? Got to get out here. I've made too much. Well, here's a fun fact. The market has no idea how much you've made. The market doesn't know that you've made $10,000 on this, and that's so much that you might cut the trade. The market has no clue. It's just doing what it's going to do. And that's what we call P&L based trading. And it can really screw you. I've seen a ton of people put a couple $1,000 in something, it hits 10K, and they're just euphoric, right? Wow, that's, and there's nothing wrong, right? If you have a goal you're trying to meet and that helps you meet your goal, power to you. But, try and leave some running with the trailing stop loss, right? Such that as long as the trend doesn't break, you still have a position, Because again, you don't want to be one of those guys that's buying a couple $1,000 of something, selling it for 5 to 10,000, and realizing it could have been a couple 100,000, later on that year or in the coming year, right? So, also a good time to point out, don't get sucked into hindsight. It's so easy to, follow your take profit strategy and your stop loss rules, and then a year later, crypto has gone crazy, and you're thinking, dang, I made $20,000 on this from $1,000. That's a big 20x, but wow, it could have been up 500x now. Damn, I should have just held it all the way up. Well, no. First off, if you took your profits at 20x, you probably would have taken them at 25 or 30. It's easy to imagine if I didn't sell at 20x, I would have held until 500x and sold the top. Probably not. You probably wouldn't have. And at the same time, this mindset is very damaging, right? I've seen it time and time again, and if you follow me on Twitter, I kind of joked about it last week, but someone will buy in 4 or 5 projects and he'll sell them all successfully for a 2x or a 5x or something like that, maybe even a 10x. And then, they'll all go up 100x. And the guy will kind of feel like a clown, right? Because he sold it 2 to 5x or 10x and it went up many multiples after that. So he goes, all right, well, next ones I'm gonna diamond hand, right? I'm not gonna sell until 100x. And then, of course, what happens? He buys into 3 or 4 more, quote, promising projects. It goes 2x, 3x, maybe 5x from his entry. I'm not selling, diamond hands, baby. Woo, let's go. I'm all about the community. Yeah, gonna hit that 100x. They all pull back to his entry, and eventually they all go to 0. And then the guy says, well, that was stupid. I should have taken the free money. What was I thinking? I didn't follow my rules at all. The next one, I'm going to go back to my original strategy. He goes back to his original strategy. He sells some at 2x, 5x. His trailing stop hits maybe around 10x. And what happens? It goes up 100x. And the guy bangs his head on the table. I've seen it time and time again. I've been there, right? But guess what? That guy that's following that is probably long-term profitable. And that's more than 90% of people can say. Right? So don't focus on, if the run goes from $100 to $100, I have to be in around $1 and I have to be fully out around $100. It's silly to think this way. As it goes up, when it's all over, you'll always say, man, I knew I should have bought here and I knew I should have sold here. No, you don't. You did what you thought was best at the time. Okay, so try not to get sucked into hindsight. When this crypto bull market and when every big power trend in any asset is said and done, it's always going to look so obvious when the chart is painted, right? But on the way up, you're dealing with so many different factors and uncertainty. We know it's not really that simple. But with this, it kind of does become pretty simple. So let's go over each of these, and then we'll go over the simple profit-taking strategy, and then we'll look at some examples. I already got about 10 minutes. I'm not trying to make this too long, but it's really important, so I'm not really trying to focus on, no, it's too long a video. Like, if you guys really care about this stuff, you probably have 30, 40 minutes to learn about this. So looking at the first one, the EMA stop loss. So if you guys have watched previous videos, I use these waveform bands, right? It's a bunch of EMAs from 8 all the way to 60. And then these are exponential moving averages. And then we have simple moving averages, pi, the 314, and the 200. So an EMA stop loss is essentially just going to be cutting the trade when you lose a key moving average, and then, it's kind of up to you which ones you want to use. For example, maybe you want to use the daily 60, also known as the bands, right? Remember, we have the 8 EMA, this purplish one is the 30, and the white is the 60, aka the bands, right? The bottom of the EMA bands. So maybe you say, all right, well, maybe you bought some on this breakout here. You're taking some profits. Again, we'll go over that in a bit. But then when you close below the bands, you cut the trade, and you wait for a new uptrend to reemerge before getting back in. Simple as that, right? Here, you hold the bands, no closes below. And again, we're not super point specific, right? If you zoom in here and it's 0.001% below the bands, I don't think we worry about that. This is clearly a close below the bands, right? That's what we're talking about here. That's an EMA-based stop loss. So I think that's a decent one. Hold on. I gotta sneeze. Whew, excuse me. So I think this is a decent one. If you go look at a lot of trends like, Bitcoin, even just a simple, EMA following strat is going to be pretty good, right? You get in when you close above the EMAs, and when they flip bullish, you get out when they're bearish. You get back in when they're bullish. You get back out when they're bearish. Maybe you're in here. Maybe you're out here. Maybe you're in here. Maybe you're out here. Maybe you're in here, out here, back in here. Out here, back in here, and you'd still be in today. So you can see, you're going to capture a lot of moves. Capture pretty much all of this, most of this, a little loss here, probably a break even here, buying in here and selling and break down. Little loss here, big win here, capturing basically all of this just from an EMA trend following strat. And then you're still in this trade since, 44K and we're at 66. So it's solid, right? It's gonna work well. You're gonna get faked out sometimes, but for example, just looking at last cycle's powerhouse move, we break above the bands out of this little downtrend here, right here, and we don't close back below the bands until way over here, right before it gets cooked. This is from 11K Bitcoin to, 50, and you ride all the way to 60. I mean, that's pretty good, right? That's a massive trade for simply, oh, look, we closed above these EMAs that flip bullish. Oh, we closed below these EMAs that flip bearish. Super simple. It's not the best. I do think in general a market structure based stop loss is a bit better, but I kind of like to use these in tandem. For example, we lost the EMAs the same day that we lost market structure here. That's a confluence of stop loss methods, if you will, as well as we closed below. Here was the last high we made on Bitcoin. And I guess we should zoom in to kind of see this better. Right, this is the last major candlestick setup. You see this BCI here. So we closed below that, and then we lost market structure, and we lost the bands. That's 3 stop loss methods, and once by this point, you should probably cut the trade and, wait for clearer waters. Maybe you hop back in here and you're trading this a little bit, and then it breaks down, you're back out, and you're waiting for a new trend to emerge, so on and so forth. So that's the EMA-based stop loss. I think that's very good. Definitely one of my favorites. And then, did I get rid of my? Yeah, I guess I did. And then my next one is the candlestick-based. And again, if you guys watched, what was it, 3 or 4 videos ago, we studied all the different candlestick setups. The bullish engulfing, the bearish engulfing, topping tail, bottoming tail, BCI, stuff like that, right? A candlestick setup stop loss strat is essentially just, right? Let's say, you got in this, you're watching this downtrend, you're waiting for it to be a new uptrend. Kind of starts here when we get a new high. We flip the bands, right? That's a pretty decent place to start. You've also had a few candle setups at that point. So maybe you buy in here and on this little bullish engulfing here, and maybe on this topping tail takeout here, right? There's your entry. So amongst the other profit-taking strats we're going to talk about in a minute, after taking those profits, you want to trail out some with a stop loss, right? So how do we do that? With candlesticks, okay? Well, here's a big candlestick setup. Let's go ahead and turn off the bands since we're not using that for this. We don't really need it. Again, here's a massive topping tail that gets closed above by this candle. Okay, so our current stop loss with that candlestick setup is either below the topping tail candle, which is, somewhere around here, or you can use this local low with the candle right below it. Or with a topping tail takeout, I quite often like to just use the candle that takes it out as a stop loss. This is a massive sign of strength to have the buyers come in, push this all the way up, only for the sellers to push it back down. And then 2 days later, 3 days later, the buyers come in with massive strength and take out this region where the sellers were selling, right? For that to happen, this is a clear point of significance, right? So you really don't want that level to be lost. But, if you want to use the topping tail candle as your stop, I think both are fine. Regardless, that's your original stop. If you bought this candle, or, if you bought this one, your original stop's going to be below there, right below the engulfed candle. So let's say you bought this one, right? There's your first entry and your first stop loss. Okay. And then you see a topping tail takeout. All right. Well, you raise your stop, as in the point in which your trade is now invalidated, to below the topping tail takeout, or below, the candle that did the takeout. Either one's fine. You get another bullish engulfing. Great. Raise up your stop to below the engulfed candle. Great. You get another one here. Right. There's these two here. And here's another one, a 2 candle delayed engulfing, right? This candle closes above this candle here. Great. Let's raise up that stop again. And it looks like on this candle, you probably have your trade cut. Okay. because right here, we can see this candle closes below our stop loss level, right? And then, you might be able to see, oh, look, well, there's a big bullish engulfing right after. Should I really have cut the trade? Yes, right? This trade is complete. Okay, if this is going to be a new trade, there's nothing wrong with that. You want to buy in this new trend here, that's fine, right? But this little trend is done. The trade you were in during this trend is over. Okay, and you see how nicely the candlestick setup kind of incrementally moves up your risk, right? So you might be at, let's say you bought this candle, you might be at no profits here, 1,000 here, 2,000 here, 3,000 here, 5, 6,000 here. And at this point, if your stop loss is hit, the worst that's going to happen is you win $3,000, right? Versus if you keep your stop below your entry the whole time, you get one big nuke and you lose everything. So I really like this candlestick method. It's really simple, really straightforward. This is going to have you out of the trade sometimes a little bit sooner than, say, the next one we're going to talk about. But I think this is very consistent. I don't know if I prefer this one to the EMA based. Again, I really like all of these in conjunction. When we close below a candlestick setup, and then we lose the bands, and then we lose market structure. When you have all those things happening at once, that's when you know this is probably cooked, right? Okay, we could do more examples of this. If you guys ever want more examples of these individual stop loss methods, I actually go over them quite often on stream, but I'd be happy to record separate videos. And this is something I'm going to do, guys. If you guys ever have questions, I will add a bonus section to these course videos, and I'll just keep adding. I'll just always be adding updated videos, different ideas, more clarification on certain things. Anything that you didn't feel was expanded on enough or presented properly, I'm happy to make more videos later on. I just kind of want to get the base course out and ready. So, yeah, so we have EMA-based stops, we have candlestick-based stops, and the next one is a percent-based fixed stop loss. And I'm not gonna say I hate this one. Again, this is better than nothing. If you don't have any stop loss, at least use this. But I just think this is kind of amateur. And what it means basically is you choose a value, let's say minus 5%. If the market pulls back more than 5% at any given point, I'll cut the trade. Or maybe it's 10%, right? And I just think you're not giving yourself enough room to actually be involved with the trend, because you're going to have plenty of trends that go up 50%, 100, 200, 500, 1,000%, that all along the way are going to have more than a 5% pullback at any given time, but without actually breaking market structure or the EMAs or candlestick setups. Like, even if we just, on this nice Pepe run, if you look in here, right, between this candlestick setup and this one, we have all this price action. And if you go into the 4-hour, you can see, shoot, it doesn't even take that. Imagine you bought in here, right, on the original breakout or whatever I said, somewhere down here, whatever it is. Just in this little section of candles here, that's more than the 5% pullback. Just in that day. Literally right after your entry, before you make a higher low, which completely validates your entry, there's an almost 20% pullback. Fixed stop losses are not good. It's better than nothing, for sure. This guy will still make some money on this trade probably, but it's not good. You're much better off using an EMA-based stop, right? Your EMA's flip bullish, you're in. EMA's flip bearish, you're out. That's a really good one. Or a candlestick-based. Percent fixed-based, I don't like it. Again, there's people out there that are definitely successful with it. Won't be me. I'm going to stick to the ones I really like. All right, and then the last one here is, again, my favorite, and that's a trend-based or a market structure-based trailing stop. And that's essentially, and again, I always focus on this on the upside because in crypto, we're definitely focused a lot more on buying assets that go up versus shorting assets that go down. For example, if you were trading, the Turkish lira, you'd be the complete opposite, right? That thing always goes down against the dollar, so you'd be more focused on the downtrend. But for most people that are watching this, you're probably going to be trading crypto like I do, so we're going to focus more on the strong uptrends. But everything I'm saying is the exact inverse on the downside. It all applies 1-to-1. Just flip it. I don't need to spend twice as much time going over on the downside, but anyways, just pointing that out. So trend-based trailing stop is just you cut the trade when the pattern of higher lows and higher highs is done. And again, I always draw it like this. It is not always going to be this clean, where there's a very clear lower high and then lower low. Sometimes it's going to go straight from the highs down to the lows, wick back up, consolidate, maybe go to the highs again, chop. A lot of times it's going to be very gross. And that's why it's important to stick to your guns, right? If your trade thesis was invalidated, cut the trade. And then if you immediately cut it and it's right back to the highs, you want to buy back in, new trade. If you want to buy it with new risk, that's a new trade. Don't treat it as some extension of this previous one. That one's done, right? This uptrend was cooked. That trade's over. If this is going to start some new trade, great. Let it be a new trade. Don't focus on, I sold the lows and bought, I had to buy in higher. That's a good thing. I mean, obviously, it'd be better if you just held through it all, I guess, but it's a good thing it went higher, right? That's a new opportunity to make money. For example, this Bitcoin kind of fake out below the bands here, right? You have a key market structure break. Right, here's your market structure, something like this. And then boom. You close below key market structure, you close below the bands. If you've been riding this up from 27, 28 to 30K, all the way to 47, 48, 50, that's a good time to get out. All right, this trade is done. This little trend that you've been riding is cooked. And then what happens, right after, it reclaims your EMAs. You get two or three candlestick setups in here. You get a nice little angular consolidation. And then you break out right here. Like, you can just buy back. That's a new trade. Is it really that bad to be in here, cut here? You capture all of this difference, and if you're following the take profit strategies we're going to talk about soon, you probably have some better sales, up in here. And then you get to re-enter, if you're cutting here and you're re-entering in here or in here, that's a tiny difference. And then you're capturing another massive move. And this is a good thing because here's what really traps people in crypto, especially in bull markets. You get used to buying the dip. Don't sell the dip. Don't puke your positions, right? Don't give up this opportunity. Well, at some point, you do want to sell the dip. You already know you're not going to sell. Realistically, you're not going to sell most or all of your crypto or anywhere close at the top. The idea, as we talked about earlier, that you're going to buy most of your stuff here and you're going to sell most of your stuff here. It's unrealistic. But again, also want to point out during 2021, 2020, we had an insane power trend that respected the bands and market structure all the way up. It's not always going to be that clean. Like I said, sometimes you're going to have fake outs, reclaims, another fake out, it breaks down again. We just got really lucky last cycle where it pretty much just followed the trend all the way up until it broke. That is not always going to happen, but it does make for a good example because it looks nice. But, oh my gosh, lost my train of thought. Oh, yeah. Nope, I definitely just lost my train of thought. Where the heck was I going with that? Right. Yes, the trap that is always buy the dip, don't sell the dip. Well, guess what? This dip you wanted to sell, and this dip you wanted to sell, right? Just like, this dip you wanted to sell, and this dip, and these dips, and pretty much all these dips, because after that, crypto got wrecked from, 40, 50K Bitcoin all the way down to 15. And this is just Bitcoin. We all know if you're involved in crypto at all, most altcoins went down 90% plus. Some of them went down 90%, only to bounce and go down another 90% over and over. So at some point, you want to be selling the dip, which is going to be, again, after you've basically, all you've seen for a year or two on end is this guy sold the dip on his 5x, 10x, and now he missed out on $10 million. It's all over Twitter. This guy could have had $10 million, but he sold his $50 bag for $20. You're going to see that for years on end or months on end, and you're going to, condition yourself. Don't sell the dip. I refuse to be one of these people that sells too early. And I'm for that. I'd rather sell late after the trend breaks than sell early thinking I'm super smart on the way up. Or maybe a little bit of both. And that's what we're about to get into with our take profit strategy. But again, if you get comfortable with this, oh, look, here's a trend break, an EMA break. All right, I'm cutting the position. Ah, shoot, that ended the bottom. Guess I'll buy back in. Look at that. You don't miss anything. And sometimes, your buyback in is going to be higher than you would like. But guess what? If this breaks here, you're going to be comfortable selling it because all right, well, that's a trend break. And, candlestick setup break and an EMA break. Great. This has been a good trade. Time to cut it. And if we reclaim and get a new uptrend, I'll buy back in. And that'll work, and that'll work, and that'll work. But then when the big one comes that you want to be selling the dip, people that are just diamond handed the whole way up, they're going to say the same thing. Don't sell the dip, diamond hand, right? We're going much higher. You're going to sell the dip as you usually do with your trailing stop. And then when everything gets cooked, you're not going to be stuck holding the bag. What is the cost to ensure that you're doing this? Sometimes you're selling the bottoms. And again, the same thing happened back in 2017 bull market. We have these powerhouse daily uptrends, and then you have these harsh trend breaks. But all the way up, again, I'll post all the ones I can see here, right? Here's a pretty big one. EMA break, EMA, trend break, whatever. On all of these, there's a little daily downtrend that gives you a great new entry. Right? Every time you reclaim the bands and make a near-term higher high, if you guys aren't kind of following what I'm talking about, right? You have a little downtrend here, you bounce to a lower high, you go lower. Here, you take out that lower high. Boom, new entry. Here, you bounce to lower highs, boom, you take out these lower highs, new entry. Same thing over here, lower highs, boom, you take out these lower highs, new entry. Lower highs, boom, new entries. Right? So your opportunity costs might be selling here, buying here, selling here, buying here, selling here, buying here, selling here, buying here, something like that. And your profit, which is what you really care about, is something like this, like this, like this, and like this. And guess what? All the way over here, when you break this level, and you're making lower highs and lower lows now, you're probably going to be comfortable getting out of most of your positions. And look at the date, guys. January 2018, February 2018. You go look at the market cycle, right? This might be the top, but this is all the top big picture, right? When you consider this run, this is the top, right? And, again, you're not going to be selling the actual top. The actual top's around 20K. You might be cutting your trailing stop at 10, 12, something like that. But, most people have cut their positions long before this, and most people will hold a lot lower before the bear market bottoms, 70% lower. This is huge. All because you were comfortable the whole way up, cutting the lows if you had to ensure that you're still following your rules. Rebuying a little bit higher, maybe you're cutting the lows, rebuying higher, right? So on and so forth. And then when you really should be cutting the lows, you do. And you're out basically at the top of the trend. Cutting at 10 to 12K before we hit 3K, that's a pretty good one. Anyways, I'm kind of harping on this a little bit, but I just want people to be comfortable with this, comfortable with selling the bottom if it follows your rules, right? Anyway, so just to clarify, right, EMA-based stop, when you close below the bands, aka the 60 EMA, that's when you cut the position, right? So if we were to close below, this level, and again, I use daily closes or 4-hour closes or whatever chart you're trading on, use the closing of a candle. Some people want to use strictly price-based, right? If you trade at all below this level, cut it. Power to you. I prefer to wait for a close. Sometimes it's going to have you selling a little bit lower, but I prefer that that method. Sorry, I had to drink some water. So yeah, EMA-based stop, candlestick setup stop, where you get a candlestick setup, that's your stop loss. You get another one, you raise your stop loss to that, so on and so forth until you get a candlestick setup that fails, and then you cut it. Pretty simple. Percent-based fixed stop loss. I really wouldn't use this unless you have no other options. You just pick a value, 5%, 10%, and you say, if at any given point the market pulls back more than that, I will cut the trade. I think it's very amateur, but again, it's definitely better than nothing. And then my favorite, the market structure based stop, where you're following the pattern of higher highs and higher lows. And when that breaks down, you are cutting it. And the flip side is true. When after you cut it, you get another market structure break to the upside, which we get here. We get a new high above these key pivots. Get back in. If you want to, take a new trade, right? Okay, so let's see how long we spent on that. We spent about almost 40 minutes just talking stop losses. But again, this is something, I've used these strategies for almost 8 years now. It's worth an hour of your time. I promise it's worth an hour of your time. Okay? And the latter half of this video, we're going to talk about my take profit strategy. And keep in mind, this is variable, right? This is not, I don't always strictly stick to this, but I'm, kind of a pro in my field, if you will, or I'm definitely a lot better than I used to be. So I feel as long as you understand the risks of what you're doing, your take profit strategy can vary. But in general, especially if you have no take profit strategy, this is a really good, really simple one to follow. Okay. So, again, I'm going to be using Pepe here as examples. We're going to go through an example that doesn't perform that well. Your typical entry pretty much ends up your typical exit. And then I'm going to go over one that works really well, where you get a good entry here, and then you'd still be riding that today. Okay. So let's go over it's basically 3 steps, right? We'll just type them out. So step 1, your first take profit is after the initial surge, which is 2 to 3 candles in your favor. And we'll talk about what in your favor means in just a minute. Second step, or the second take profit, is after the secondary surge, which is 5 to 8 candles in your favor. And the final take profit is your preferred trailing stop method, right? And again, for this one, almost always I use market structure based, which quite often happens around the same time as an EMA structure based stop loss. So one of those two, or candlestick setup. Excuse me. Okay, and this does not mean you only need to take profits once, twice, 3 times, right? You can, you can take profits 2 to 3 candles in your favor. You can take more 5 to 8. You can take more 10 to 12, more 17 to 18. Or you can take profits a lot more often than this, on the second candle, and on the third, and on the fourth, and on the fifth. It's all up to you. Just try and make sure you're leaving some for the trailing stop all the way up. Thus, if you buy something at, a breakout at $1, and you take some profits at $2, and you take some more at $3, and then maybe some more at $5, and then you just leave the trailing stop. Crypto's crazy, guys. You will go up massive amounts of money without breaking a daily market structure. I mean, even just looking at like dog with hat, for example, look at this. We've barely even broken the daily 8 EMA, let alone the bands that just started to exist. And we have not once on this broken daily market structure. You had a big breakout here, and then you just ran and ran, little pullback, ran and ran, little pullback, ran, little pullback, ran. This has gone from 30 cents to $5. $5 without a deep pullback, without breaking market structure. And it looks like it wants to go for more. So you want to keep some with market structure or whatever your trailing stop is. Again, I'm pretty sure the candlestick setup applies here. Here's your breakout. Here's a BCI. I'll just outline it like this. BCI, new stop. BCI, new stop. BCI, bullish engulfing, whatever, new stop. Bullish engulfing, new stop. Doesn't close below, still valid. BCI, new stop. BCI, new stop. And I got a feeling we're going to bullish engulfing today. Probably will be a new stop here. Look at that. It holds the whole way up. So let's say, you bought in here at 50 cents or something, and let's just do this. Let's do our first example here, because this is, most of us want to know how we're going to trade the power trends, right? We'll go over some examples of less, exciting trends, where you're not going to take big wins, but how am I going to profit take on this to still make a lot of money over the long term, but also ensure that I'm reducing my risk all the way up, right? So here's your breakout. Let's say maybe you bought this setup here, but let's assume you didn't, right? Let's assume you bought late on the breakout, which is fine. Okay? So when I say candles in your favor, what I mean is a candle that goes above the high of the candle you entered on, right? So this one clearly does. Let's say you entered on this candle, right? These two candles, even this yellow one that's a quote bullish candle, it doesn't go higher than the high of my entry, so it's not in my favor, right? So again, let's say, and it doesn't mean you bought the high of the candle. Maybe you bought here at like 55 cents, but when you're talking take profit strategy, right? This candle is very much in your favor, right? This candle goes above the high of the previous one. That's one candle in your favor. Now, to be two candles in your favor, you need to go above that candle, or that candle's high, right? So this next one is not a second candle in your favor. Don't TP right away thinking that's your second candle. No. First candle in your favor goes above the high of your entry candle. The second candle in your favor goes above that first candle's high right here. And then your third candle in your favor goes above that candle's high, which the next one does. So there we have it. 2 to 3 candles in your favor. This candle or this candle, you want to take your first wave of profits. And that's solid. Entry at 55 cents. First wave of profits at $1.30 to $1.40. That's a great first wave of profits, right? Now here's the kind of one of the more variable parts. Well, how much do I sell? That is up to you. And, there's no right answer. Do you want to sell half, right? You're up at 2x. If you sell half, say you bought $10,000, you sell half here, you're going to make at least $10,000. Meaning if it comes all the way back to your stop loss, which at this point would be this BCI, first off, because the BCI is above your entry, you're not going to lose money regardless. But let's assume you didn't get that. If you take off half on this 2x and it comes all the way back to below your entry or, even to 0, you're still going to have made money, right? You bought 10,000, it goes up 2x, it's worth 20,000, you take off half, you have 10 in profits, and you're trailing 10 with the trade. You can't lose. That being said, if it goes really hard, you're probably going to wish you took off a little bit less so early. But it's really up to you. I would typically say initial surge, 2 to 3 candles in your favor, take off a third. It's pretty safe. It's enough that if you go straight back to entry, you're not going to take a full loss. And it's not too much that if it keeps going really hard, you're not going to feel like you sold too much too soon. So I would say somewhere between there, 20, 25, 30, 35%, something like that on your initial surge, which is 2 to 3 candles in your favor. And then the next one is the secondary surge, which is 5 to 8 candles in your favor. Okay, so let's keep following this, right? Where was the entry here? 1 candle in your favor. Excuse me. 2 candles in your favor. 3, 4. Come on. 5. And then this one technically goes in your favor. We'll count it. 6, 7, and 8. Okay, so initial surge. 2 to 3 candles in your favor. First TP. Really solid. Secondary surge. 5 to 8. So what do we got? 1, 2, 3, 4, 5, 6, 7, 8. So somewhere in here, you're taking your next wave for profits. Again, how much is up to you? 20%, 25, 30, 40, right? It's up to you, right? I think a good idea is to make it a little bit more than your first one. You know, if you TP 25% on the initial surge, maybe TP 30 on the secondary. And then the last one, right? The last take profit is a trailing stop. And this is just a baseline, right? If you get another new high, you want to cut another 10%, go for it, right? You don't have to just strictly follow these rules, but I think it can really help, especially if you're making a lot of the same mistakes over and over. Try this take profit strategy, okay? And then, like I said, there's the trailing stop, right? So you have your initial surge TP here. Somewhere in here, you have your secondary surge TP. And now you're just following, let's say you use a candlestick method and trailing stop, right? Your initial stop was either below here or, you know, maybe below your breakout candle, one of those. You raise your stop to your BCI. You get another BCI here. You get a topping tail takeout here, plus kind of a bullish engulfing. We'll raise our stop to the low of this move. Bullish engulfing here. Right? If you're using a hard base stop, you probably get wicked out here, and you'll have to rebuy this new candlestick setup here, new trade. But I tend to use closing basis stops. We don't close below this level here, so this is still valid. We get another BCI here, another one here, these 2 candles, and then, like I said earlier, we're probably going to get another one here if we close above yesterday's highs, and that'll be another chance to raise your stop. So, have you played this, right? You bought in, you know, either at 35 cents on this engulfing, or maybe a little bit late on the breakout at 55 cents. You took some profits, maybe 30% from $1.20 to $1.40. You took some more profits from maybe $1.90 or 70 or something up to maybe $2.30, somewhere in there. And then your last trailing stop is now running at almost $3 from your 55-cent entry, meaning if your trade is invalidated below that level, you will be guaranteed 380% gains on the last part of your position, right? Really solid, you know, really solid. You follow your rules. You don't really have to think. You come in at every daily candle close. And again, this works for all time frames. You know, it works in the 15-minute, the 2-minute, right? You come in at your daily close. All right, was my stop loss invalidated? No, okay. Did I get more candles in my favor? I did. Okay, well, how many? I was at 3. All right, I'll take some profits. You know, did we lose my stop loss level? Oh, we did? Great, I'll cut the trade. And I'll keep my eyes out for a new entry. Really, really simple stuff. And it's pretty much the same example over here on Pepe. Right, you know, let's say you're watching this little downtrend here. You're waiting for a nice little breakout. There's a pretty good one right here. Right, your last low came from this lower high. You broke above that here, and you broke above the bands. That's a good time to start paying attention. Another example would be over here. And this is a good example of, sometimes it's not always, let's do this one first. All right, let's say you bought in on this little double bottom here, right? You bought in on this candle, and let's say you used the candle low as your stop loss. Or, of course, you know, I would more typically stick to the local low. You know, it's whatever you want to use, right? You buy in on this candle, immediately you get 1 candle in your favor, right? You go a little bit higher on the next candle. 2 candles in your favor, 3 candles, oops, 3 candles in your favor right there. So somewhere on one of these candles, you want to be taking your first wave of profits. And it's not super exciting, right? You bought in here at around, looking at this price, you bought in here around 100, and your first take profit is at 20 to 35, only 20 to 30% gains. I know in crypto, that's not exciting, but guess what? You know, you're going to end up having sold that initial surge at pretty much the top of this move, right? Because sometimes all you're going to get is 2 to 3 candles in your favor. And that's why I put focus on the initial surge TP. Because it's nice to imagine you buy in and then you get this kind of trend after. But sometimes you're going to buy in here and it's going to do this and it's going to flop. If you're taking some profits on that first 2 to 3 candles, you might go from, say, losing $1,000 to losing $700, right? And so that's why you do that, okay? It's not flashy. It's not going to always make the most money, but it does reduce your risk significantly, okay? So again, entry here. We had 1, 2, 3 candles in your favor. It looks like we get a 4th one here. And then if you're using a candlestick based stop, you probably get out here and you have to rebuy a new setup. If you're using a market structure based stop, right, your last higher high was here, came from this higher low, so that's your stop. It doesn't get invalidated, so we keep following the trend, right? We had 1, 2, 3, 4 candles in your favor, and then 5, 6, a little bit higher, 7, 8. So somewhere in here, you'd be taking your secondary level of profits. Look at this. Here's your trade entry, you know, double bottom here, something like that. Entry here, first wave of profits, second wave of profits. You're basically selling the highs of this move from October to March. And I know it's easy to say, well, look, it goes way higher. Shouldn't I have just hold? Sure, right? You know, if you want to play a weekly setup, right? You know, if you're buying the weekly breakout and your stop's below here and then you want to add on the next couple weekly setups, that's fine. But if you're taking a simple daily swing trade, focus on the daily trend. Don't get sucked into what's going to happen 4 months later. So you buy this breakout, 2 to 3 candles in your favor, you're taking profits. Here's the 4th candle that goes above and favorable. And then above there is the 5th to 8th. Look at that. You're selling basically the highs of this entire move. And then when the trend eventually breaks down, which happens, you know, you could, if you're using a candlestick based stop, again, you probably cut it here and you had to re-enter somewhere in here. And then your next candlestick setup fails in here. If you're using a EMA based stop, you're getting that over here. And if you're using a market structure based stop, you're probably getting out somewhere around here, which ends up being the lows. But again, who cares, right? Who cares? Because guess what comes right after? A new entry. Which again, let's see, how long have we been going? 53 minutes. We'll do this last one quick example, and then we'll get you guys out of here. And again, I'm totally happy to do an entirely separate video later on just on examples of this take profit strategy. I mean, some of you are going to hear it once and be like, oh, that makes sense. You know, I get it. And that's cool. Some of you guys are going to need a dozen examples. That's also cool, right? Not everyone learns at the same pace, and, you know, sometimes this stuff can be confusing. So anyways, let's say you rode this Pepe trade, you know, you took some profits here, you took some profits here, and then you stopped out, you know, somewhere in here, right? When this kind of trend broke down, you stopped out somewhere in there. Okay, so you made some decent money, nothing crazy, right? But you made maybe 20-30% on this TP, 40 to 50% on this TP, and then the last piece. Let's say you took the worst of the 3 in this case, which is the market structure based stop. That sale is basically at your entry, right? Maybe a little lower. So you have a 20 to 30% win on the first TP, a 40 to 50% win on the second TP, maybe a minus 5% on the trailing stop. Okay, so overall, profitable trade. And you like this strong move off the lows, you want to see if there's going to be a higher low after, right? And, you know, kind of a breakout of this previously bearish trend. Okay. So you're watching your daily trend, right? Currently it's lower lows and lower highs. Lower lows, lower highs, lower lows. Boom. Higher high. Let's look for the higher low. And you can just buy the higher high. You know, maybe you buy some on this candle, maybe half risk. And again, we'll go over risk in a couple videos. And then you get a bullish engulfing candle right off the EMA flip on the bands. Right? There's your entry right there. And your stop loss goes below the low. Simple as that, okay? So let's follow this, right? Immediately, you get a candle in your favor the very next day. That's not always going to happen, but that's always nice and welcome. Next candle in your favor, right here. 2. 3 candles in your favor. Great. Look, see, this is what you love to see. You're not always going to see this, obviously, but you enter, and then within the same week, you're making good money. So you bought here at 120, and then you're taking your first wave of profits somewhere from 180 to 280, somewhere in here. Whether you want to do on 2 candles or 3, it's really up to you. Great. You know, take off 20, 30, 40%. 4 candles in your favor. 5. 6. 7. 8. Okay. So here's your entry. Here's your first take profit. Let's see. 2, 3, 4, 5, 6, 7. Here's your next take profit somewhere in here. So you've already got some good sales, and you've already got a new BCI, which you can add on these BCIs if you want. I think it's always a pretty good play. But at the least, you can raise your stop loss from here to here. So now you're guaranteed if your invalidation is hit, you're still going to make at least 115% on your trailing stop. Right? So 2 to 3 candles in your favor. Take your first wave of profits. 5 to 8. Take your next wave of profits. And then let's say in this one, we'll just go over all of them. If you're using an EMA-based stop, obviously, market structure has not been lost yet, so there's no reason to get out. If you're using a... did I say market structure? I meant EMA-based. Yeah, EMA-based stop. EMAs haven't broken yet, so no reason to get out. If you're using a candlestick setup stop, let's go over the candlesticks really quickly. All right, here's your initial. Here's a BCI. Here's another BCI. Here's a delayed bullish engulfing, right? This candle gets closed above by this candle here. So new stop. And that's probably the one that gets you taken out, right? So you close below it with this candle here. So your market structure based trailing stop takes you out here. And then fixed percent, I know I'm not really going over that one. That's just going to be up to you. You know, if you took a 20% fixed percent stop, then you'd be out here. If you took a 50%, you'd still be in. If you took a 5%, you'd have been out, you know, back here. So yeah, candlestick, in this case, candlestick setup stop and market structure based setup stop are the same because our last higher high came from our last candlestick setup low, both of which get closed below, you know, one of these 3 candles, right? If you want to say, you know, oh, well, it barely closed below it. I'm going to wait for another close below it. Over here, I think that's okay. Sometimes I do that. Sometimes it's going to hurt, right? Sometimes this close is going to be way down here. Sometimes it's going to immediately reclaim. And it's really up to you in the end. But regardless, still a great trade, right? Entry, TP1, TP2, trailing stop. And if you're using the EMA based, you're still in. And likewise, you can take new trades all the way up, right? Let's say you're running this trade, but you want to do a BCI play too. So you buy the BCI, stop below the low. Meanwhile, keep this trade separate, right? When this trade hits 5 to 8 candles, you're still taking profits. But on this portion, it's a whole different trade. All right, you buy the BCI. You're watching for candles in the favor of the BCI. You get 1, 2, 3. There's your initial surge on your BCI trade. Take some profits on that addition. 4, 5, 6, 7, and you never get an 8th one, but 5 to 8 candles for a reason. Don't always wait for the 8th candle, right? So now you've got bought some here, sold some here, sold some here, trailing stop cut. You also bought the BCI, sold some here, sold some here, and then trailing stop, same trailing stop, cuts that one. And then maybe you added on this BCI as well. You never really get 2 candles in your favor, so you end up taking a probably a half loss on that one. All right, if this is your entry, here's your stop, and then your candlestick setup trailing stop gets hit here. You know, it's probably about a 60% loss on that one. So you got a big winner, a medium winner, and a small loss. All looking pretty good. And then, of course, if you want to take the next trade setup, just because you cut here doesn't mean you can't. Oh, there's a bullish engulfing. I want to buy in. Power to you. Stop below the low. You know, you get a higher low here with another bullish engulfing setup. That's a chance to add, right? You know, you don't, just because you sold doesn't mean the bigger picture trend is over, right? This trend might have broken down, but this trend might continue. You know, you go look at the monthly, for example. This is just one big move up. You can very easily pull back a little bit and keep going much higher. Okay, so probably the longest video I've done so far, but definitely one of the most important, right? If you don't have trade management skills, all the analysis in the world is not going to help you. So definitely take some time, you know, try and map out some examples, map out bad examples too, right? And mess around with it. Like I said, not everyone has to use these stop loss methods. Not everyone has to follow my take profit strategies. I don't even use these sometimes. Sometimes 2 to 3 candles in my favor, I don't want to sell just yet, you know, and I'm accepting the risk that comes with that. You know, that's, you're more than welcome to do that at any point. You know, if you bought in here on Pepe and you don't want to TP here because you want to wait and sell up here instead on your first TP, that's fine, but your initial entry was risking 10% to your stop loss. At this point, you're now risking 60% to your stop loss. That's a massive difference. So every step it goes higher that you don't TP, without giving you at least, you know, a new level for your stop, you're risking more and more and more all the way up. So just keep that in mind, guys. You know, I get everyone sometimes has those greedy moments, and I'm not saying, you know, don't do it, but you got to know your own risk tolerance, and you got to manage your greed. Greed management is one of the hardest things in investing. You got to know when to be a little bit greedy and when to be a little less greedy. How are you going to learn that? You're going to have to be wrong a lot. It's going to just come with experience. So don't be afraid to mess around with these rules. Don't be afraid to stick to them like, you know, like they're your best friend, right? But anyways, I guess that's all for this one. We got 2 more videos left. Again, I don't like making these super long videos because then I know some people aren't going to watch all the way through. But if you guys really do care about trading and investing and making, you know, a job or a career out of this, it's worth the hour. You know, how many of you guys sit there and watch TV for 5-6 hours or play video games for 5 or 6 hours, right? Take a couple hours, watch one of these videos, watch 2 of these videos, and learn something. Yeah. But anyways, next video we'll talk about how my trading model is fractal, which we're going to see some pretty cool stuff in that video. It's not the most necessary video, but it is pretty cool, and it will kind of help with trading across multiple time frames. And then the last one after that, probably the most important, is position sizing and risk management. And that's going to kind of bring everything together, right? Because even these take profit and stop loss strategies, they're no good if you don't know how to position size and manage your risk. And we've kind of talked to that, right? Today, stop losses, you know, raising your stops, taking profits at proper levels, that is managing your risk. But the positioning sizing is key. So that'll be 2 videos from now. Anyways, thank you guys so much for watching. I hope you all enjoyed this, found it educational, entertaining. If you ever have any questions or comments or concerns, feel free to reach out to me in Block Circle. I'm always happy to clarify as much as I can. And yeah, I will see you guys in the next video. The fractal model. Take care.